Right. Good morning, everybody, and welcome to the PD Tax Budget webinar for 2021. In this brave new world of not going out, today we're doing this budget via a webinar, but hopefully next year, when things are back to normal, we can have our normal bacon butties and coffees and shaking hands along with the webinar. So on with the show. My name is Paul Davison, and I'm joined today by my colleague Vicky Elliott. And there's she's putting her hand up, and there's our vision, which is enriching lives by making tax simple. Excellent. A little bit about what PD Tax do to start off with. Tax advice, obviously, the tax partner service for accountancy firms. We do a few tax return forms. We also do share valuations of mainly private limited companies, and we do tax investigations and voluntary disclosures, amongst other things. So here's our agenda. Hoping to get finished by 10 o'clock. The first speaker today is Vicky. She's going to be running through the personal tax highlights from the budget. Then we're going to have a brief poll. The second speaker is going to be myself. I'll be going through the business tax highlights. Then we've got another poll. Then we've got questions and answers, and our plug for our upcoming webinars. A little bit of housekeeping, as ever. Say what you want to, because your mics won't be enabled at any point. Please send your questions in to us via the Q&A button to Amy as soon as they come into your head. And don't forget, we're going to be limited to the number of questions we can ask at the end. So first come, first serve is generally the rule on that. But if your question isn't answered at the end, we will contact you for a follow-up discussion after the webinar. And today we're assisted by Amy, who will be helping us with the questions. So now I'm just going to pass on to Vicky, who will be doing the private client section.
All right, good morning, everyone, and thank you, Paul. So from a personal tax standpoint, there wasn't any big changes. There'd been a lot of speculation ahead of the budget about possible changes to capital gains tax, and none of those emerged. But the key word that did crop up a lot is things being frozen. So from 6th of April 2021, the personal allowance and the basic rate band are going to go up a small amount, and then thereafter they're going to be frozen until 2026. I think essentially what that's going to do is it's going to drag a lot more people into the higher rates. So there's some interesting commentary from the IFS on this, and they suggested that in 2010 there are about 3 million higher rate taxpayers. It's currently just over 4 million, and by 2025 they're predicting about 5 million higher rate taxpayers. That's similar to what's happened with the additional rate. That limit hasn't changed since it was introduced, and there's now twice as many additional rate taxpayers as there were when that first came in. So that's the effect of fiscal drag, and that's going to obviously help bring in more tax revenues. The annual exemption for capital gains tax is going to be frozen at the current rate until 2026. The IHT nil rate band also going to be frozen. The pension lifetime allowance is going to be frozen, and the ISA allowance is going to stay at its current rate for at least the next year. So the other change was in terms of SDLT. So there's currently a reduction in the SDLT rates that was introduced last summer. That was due to end at the end of March, and that's now been extended until 30th of June. And then it's going to have a more phased withdrawal than had originally been planned. I think there was a lot of criticism about a cliff edge. So from July to September, that reduction, which brings down the rate to 0%, is going to come down from £500,000 to £250,000. And then from October, we'll be back to the old rates. I have put a link on the slides for the full rates, which we'll be sending out afterwards. They've also, government has confirmed that another change that we'd previously been told about is definitely going to come into place, which is that for SDLT from 1st of April this year, non-UK residents that are buying UK residential property are going to be subject to a 2% surcharge. Now that includes not only individuals, but also purchases by non-UK resident companies, and also UK resident companies that are controlled by non-UK resident persons. Now, it sounds quite straightforward, but as ever, there's a few complications. Firstly, the definition of a non-resident for this isn't the same as we're used to with the statutory residence test that we use for other tax purposes. So that's going to be quite a complication. And then also the definition of a company being controlled by a non-UK resident person is going to bring in some unusual situations in terms of what the definition of control is. But effectively, this change means the highest rate of stamp duty land tax is going to go up from 15% to 17%. It's also worth noting that this doesn't apply if you buy more than 6 residential properties in the same transaction. You're allowed to elect to use the commercial rather than residential rates. You can still do that and you won't be subject to the surcharge because the surcharge applies to the residential rates only. But as ever, you'd have to do comparative calculations for the commercial rates compared to multiple dwellings relief, for example, to decide which is the best way to do that claim. We're expecting updated legislation guidance next week, so we'll have more on that soon. And then finally, I just wanted to touch on the effect on family investment companies. One of the big changes that Paul will go into in a lot more detail is an increase in the corporation tax rate. Now, of course, any effect on the corporation tax rate is going to change the tax savings associated with companies. Family investment companies are generally still going to be tax effective in the right circumstances. So particularly if you're going to be using them to roll up money in the company to pay off debts, to invest in more capital assets, you're still comparing that 25% rate to 40 or 45% personally. And for inheritance tax planning, if you're gifting shares using different share classes, etc., they're still going to be helpful. All right, so that's everything from me. So I'll hand back over to Paul. Oh, no, sorry. First of all, we'll have a poll. So first poll we're going to do is, what does the future hold? So do you think that we're going to have further changes, so increases in the capital gains tax rates, increases in income tax rates, increases in national insurance contributions, corporation tax, reduction in pension annual allowances, introduction of a wholly new wealth tax, or worst case scenario, perhaps all of the above, which I can see a few people are going for. We've just got another 30 seconds or so on that poll. I think we're just waiting for a few last votes to come in. Yeah, we're about 80% now, so just waiting for the last few. All right, I think that's everybody's voted that's going to vote. I'll give you 5 more seconds to get your last votes in. Okay. All right, so I've shared the results there. Hopefully you can all see them all. So increase in capital gains tax is the biggest predictor from you all, followed by a rather pessimistic all of the above. So thank you for that. All right, and now over to you, Paul.
Thanks, Vicky. Right. Okay, so on now to business taxation. And clearly the headline of this section was the corporation tax increase from April 2023 to 25%. The detail there is that there's going to be some tapering, so profits below 50,000 charged at 19, and a tapered rate from 50 up to 250. Then anything above 250 will be at 25%. These types of tapering were in sort of 89 years ago when they had different rates back then. So it's obviously a big increase for businesses. Diverted profits tax is also going up by 6%. You may know that the diverted profits tax, DPT, relates to international companies that attempt to sort of divert profits out of the UK artificially. Big companies like Amazon and Apple will say that they don't divert it artificially; they divert it for commercial reasons. I think that's something the government and the international tax scene in general is still grappling with, because the rules still really relate to the time before the internet, when businesses were all based in offices and factories, and they've not really moved on from there. And that's something the world needs to sort out, really. That's political. So the corporation tax rate change, one question that came to my head immediately was, will it still be best to pay dividends rather than the salary for the typical owner managed business? Clearly the difference here being that salary gives a corporation tax relief, whereas dividends don't. So potentially the gap's narrowing because salary now gets that higher corporation tax relief. So we still think, though, that dividends are still better. We did some brief calculations applying sort of the first marginal £100,000 of profit above the £250,000 profit of about 25%, and we worked out that for dividends the overall tax leakage was 35.71. For wages, the leakage was 39.72. So we believe that the small salary and dividend route is still better, but the gap is closing, and we will need to look at certain situations even more closely going forward. As per the credit crunch back in the sort of late 2000s, the government has now introduced an improvement to the way that businesses can carry back losses. The normal rule is that a business can, under normal circumstances, can carry back losses just 1 year. But this rule means that they can now carry it back 3 years. So that will be helpful for some of the businesses that have struggled during the pandemic. Obviously, some businesses have done well and thrived, but a number of businesses have obviously struggled and will make losses. So now we can go back 3 years rather than 1 year and get some tax back to help us out. There will be some interesting calculations to be done to decide when you take it back and how far you take it back. But we don't know the detail of the rules yet, so we're not entirely sure how that's going to work. And the losses there, you can see the losses there are the losses which fall in the 2020 20 or 21 year end, or the 21 to 22 year end. They're the ones you can carry back up to 3 years. After that, it'll go back to the normal 1 year period. So that's an interesting change. Other interesting changes, R&D. I think there's been, I don't know what people think, but there's been a perceived significant amount of abuse around the R&D tax credit. Clearly, it's quite a generous relief, and the two things that people have been doing are saying that something's R&D when it's probably not, and utilising subcontractors in a sort of a weird way to get a higher deduction than what might otherwise be due. So to counteract this, initially they've brought in a limit, and the limit is that you can only claim £20,000 tax credit. So these are people who are making losses. You can only claim a £20,000 tax credit plus 300% of the total pay as you earn and national insurance liability for that period. So it's now capped for credits. The actual deduction, when you're reducing your corporation tax liability, is not affected by that. The cap there for tax credits really doesn't apply though if the employees are creating or managing intellectual property and not more than 15% of the R&D is spent on subcontractors. And also, it's important to note there that the government has announced there's going to be a general consultation on R&D. I think that's because of the general perceived abuse that's been going on. Clearly, it's a politically nice thing to have to encourage R&D, but there's been a significant amount of stuff going on with this. Freeport sites from the 9th of March, which is next Tuesday. Yeah, I think those who are sort of working back in the late 80s and 90s will remember the enterprise zones. I think a number of sort of old mine workings were made enterprise zones back then, amongst other things. And this time we've got a similar thing, which is basically creating tax reliefs around a specific location. The 10 locations who were successful in their proposals are listed at the bottom there. And what we have in effect is got 100% enhanced capital allowances if you go above your annual investment allowance. You've got enhanced building allowances and building and structures allowances, which is the 10%, which is a 10% rate, 10% straight line basis rather than the 3%. So the buildings and structures allowances was a allowance that was brought in 2 or 3 years ago to provide tax relief for bricks and mortar for buildings, which wasn't available. That's going to be a lot more beneficial to have your building built in a Freeport site. And similarly, along those lines, they're encouraging you to buy the land to build on, because they're saying that SDLT, I think, is going to be relieved in full, but I'm not entirely sure about that. But there's certainly going to be some quite significant benefits for SDLT. So therefore, they're trying to encourage people to build properties and locate significant businesses in these Freeport sites. We've got the super deduction. This was a number of people who talked about that. It's an enhanced deduction for plant and machinery acquired from the 1st of April this year for a 2-year period. And we get so we spend £100 on plant and machinery. We actually get a deduction in the tax computations for 130. So we have an enhanced 30% deduction that we have to adjust for in the tax computation. And there's also an improved deal for special rate assets. Special rate assets are things which don't tend to generally qualify as normal plant and machinery. They get an uplift as well. This only applies to companies, worth bearing in mind. And if you do have a super deduction asset, it's not added to the pool, it's kept separately, so that if you dispose of it, you have a reclaim of the 130% and not just the 100%, depending on what happens, obviously. And there's a bit of anti-avoidance there. The cars, second-hand assets, leasing assets, connected party transactions don't qualify for the super deduction. So it's interesting. I think thinking this through is going to be, if I buy myself some headphones for PD tax, I put those headphones through capital expenditure now rather than a normal cost. That's going to be the things which the people will be talking about, because clearly it's better to have it as a super deduction which seems to be normal planting machinery. These are the discussions you'll be having with your clients from the 1st of April. Obviously, as well, if we're planning any capital expenditure in March, if we can leave it till April, that's going to be a good tactic. There's going to be some potential EMI amendments. Those who are aware of the EMI scheme, it's a share option scheme which incentivizes key staff. It's been very successful. I think it's been going now for about 20 years. It's been extremely successful in really providing equity for staff members. But what's been happening is that the EMI scheme is only really based at relatively small companies. I had a situation recently whereby I was dealing with a slightly, not a massive company, but a slightly larger company, and they couldn't use the EMI scheme. And we had to use some sort of growth share arrangement, which is a bit contrived. It works, but it did seem to me at the time that why does the EMI scheme only apply to small people, not to large people? Because it's a lovely scheme, works well for a lot of parties. So there's going to be a consultation. I'm going to expect a brighter version announced in the coming months. One of the things that was mentioned in the budget is that people who are on furlough, that time on furlough will still count towards a working requirement if you've got share options. Because if you've got a share options through the MI scheme, you have to work a certain amount of hours a month or percentage of your time to keep qualifying. If you don't meet those objectives, you lose your qualification. So the government has confirmed that furlough will count towards that. And then last, but definitely not least, there's a few VAT things just to tick off before we move on to questions in the poll. The temporary 5% rate for hospitality, holiday accommodation and attractions is going to remain until 30th of September. And then from that date, it'll be increased to 12.5 and then back to standard rate as of 31st of March. I'm presuming that's based on the sort of the 21st of June release of lockdown. And I suppose if that doesn't happen and then we carry on further than that, then I presume they'll have to review that. But at the moment, that's the plan. An interesting one for many business owners is that the VAT penalties for late submissions will be changed. They're going to bring in a change on that. It's going to become points based. So probably not as harsh as it has been, in terms of a points base. Presumably that will be based on the number of sort of offences and the severity of the offence in terms of how many points you get for that misdemeanour. And once you've got to a certain amount of points, you'll be hit with a penalty. So that sounds interesting and probably a bit fairer than what we've currently got. And finally, the VAT registration is going to remain the same for the next year. So I think we've got a poll next. A quick poll. This is a very quick poll. There's only 3 answers for this one. I'll start it. So, were the changes announced in the budget about right, not enough, or too much? I'll just run this for another 20 seconds, and we'll get on to questions because time's running out. Excellent, thanks very much. I'm just going to end the polling and share the results. And people tend to think it was about right. I think there was obviously a clear balance, a difficult balance to be struck between trying to raise taxes to pay for everything, but not hit businesses too hard. So generally, people are thinking there that it was about right. Right. Amy, are you there?
Yep, I'm here. Thanks for that, Paul and Vicky. There's lots of questions, so I will just pick out the highlights. Given the new corporation tax rates, do you see merit in some companies where appropriate splitting their operations into more than one company to benefit from the lower tax rates?
Well, it's a good question. Clearly, there will be some anti-avoidance rules about this. And if the split is done purely for tax reasons, then I doubt that will work. Clearly, if you've got another business, if you've got I think, well, I think in the old days, they used to have the associated company rules, whereby if you had two companies which were associated, you sort of added those together and working out the two. In this case, it's now 250 is the sort of the limit. So what you'd have is, in the old days, you'd say, right, this one company's got £125,000 before you go to 25%, and the second company's got £125,000 before you go to 25%. So, yeah, I suppose that's probably going to be the rule again. I would think. The rule I mentioned first was like the VAT rule, where you split businesses for VAT purposes. But I think, yeah, they'll probably bring in the associated companies rules again, which will mean it doesn't work at all, just because they're associated and controlled by the same people effectively.
Okay. Vicky, when will a company be defined as a FIC if it is trading and also retaining and investing cash reserves?
Yeah, so first of all, a FIC isn't really a definition in its own right. It's just a term that is commonly used to describe a company that's been used for investment purposes within a family unit. In terms of the corporation tax rate, there are going to be rules around what we call close investment holding companies being subject only to the highest rate, so they won't get the small companies rate. Again, we're kind of waiting on the detail of what that will be, but if we look at what the old rules used to be, if the company wasn't wholly or mainly trading or wholly or mainly letting to third-party tenants, then that would come into that definition of a close investment holding company. So I suspect it will be something fairly similar. So if it's a company that's getting a lot of income from general investments, then it's likely to end up coming within those rules.
Hi, could you confirm when the new R&D rules apply from, please?
I actually double checked this while Paul was talking because I saw the question pop up.
Oh, thank you, Vicky. You saved my bacon.
So I believe the changes to the cap are coming in from 1st of April this year. The other points that were discussed to do with R&D is actually a consultation. So I think they've announced the details of that consultation, and then we'll just have to see after the results of that come in when any future changes might come about.
Predictions for any autumn statement and next budget, should this be a call to action?
Yeah, I think really it's going to depend on how well the economy does over the next 6 months as to what we see in a autumn budget. And there's a raft of consultations that are going to be announced later this month. I think they've said that some have been announced in the budget. I think most are going to get announced around the 23rd of March. So I think we'll see then in those consultations which areas are going to get looked at. But I think over the next few years, there's definitely going to be more increases in tax.
Okay, and for one more.
Yeah, one more.
What do you think of the new HMRC enforcement enhanced tax recovert powers for abusers?
Good question. Could you just repeat the question again, sorry, Amy?
What do you think of the new HMRC enforcement enhanced tax recovert powers for abusers?
Don't know an awful lot about it. I think clearly tax abuse is still big, and people do, even though the new rules came in for like the loan charges and that type of stuff and the EBTs, people are still taking the mickey out of the rules. I've seen evidence just recently in a company that went into liquidation. So anything they can do really to improve their powers, I think, if there's clear evidence of evasion or schemes which are just aggressive, I think anything you can do really to improve their powers needs to be done, because at the moment, even like the R&D things I mentioned earlier, as far as I can see, some of these claims are out of control, and the government's hemorrhaging money. So anything they can do really to stiffen up the powers, to my mind, is got to be welcomed, because people have to pay the right amount of tax, and there's a lot of people who are still taking the mickey. Okay, thanks Amy for those questions.
Thank you.
That's the end of the seminar, everybody. So we hope you enjoyed that, and you've learned something, at least one thing, and we'll look forward to next year's budget seminar with coffee and bacon butties. Okay, thank you very much. I can stop.